Welcome to our video on understanding childcare tax benefits. Today, we will explore the differences between a Dependent Care Flexible Spending Account, or DCFSA, and the Child and Dependent Care Credit. We'll break down the advantages and disadvantages of each to help you determine which option might be best for your family. In this video, we will cover an overview of Dependent Care FSA and Child and Dependent Care Credit. We'll go through how each works, their benefits, and potential drawbacks, and aim to provide a clear comparison to help you make an informed decision. First, let's explore what a Dependent Care Flexible Spending Account is. A DCFSA lets you set aside pre-tax money from your paycheck specifically to pay for childcare expenses. This reduces your taxable income, so you benefit immediately from tax savings. Let's get into some details about how a DCFSA functions. Annual contribution limits to a DCFSA are set by the government and can change slightly every year. A clear advantage of using DCFSA is the pre-tax savings you enjoy throughout the year. However, you need to estimate your annual childcare expenses upfront, and any unused funds by the end of the year are usually forfeited. Also, the funds can only be spent on eligible care expenses for qualifying dependents. Next, let's delve into the Child and Dependent Care Credit. This credit reduces your tax liability once you've filed your tax return. It's calculated based on a percentage of your qualifying childcare expenses, and this percentage is influenced by your adjusted gross income, or AGI. Several key aspects characterize the Child and Dependent Care Credit. It is only available on qualifying expenses and provides a direct reduction to your taxes owed. The percentage of the credit is dependent on your income. It's noteworthy to mention that this credit only comes into play when you file your income tax return. Now that we covered both options, we find ourselves at a crossroads. On the one hand, the DCFSA offers immediate tax savings, but demands the prediction of expenses and carries the risk of forfeiting unused funds. On the other hand, the Child and Dependent Care Credit requires no upfront estimation, adjusts to your actual expenses, but you can only claim it during tax season. Depending on whether you prefer steady savings through the year or an adjustment-based credit may guide your decision. Let's pause for a quick quiz. What is a key advantage of using a DCFSA? Your options are A. Immediate tax savings. B. No need to estimate expenses. C. Adjusts based on actual expenses. D. Available for any expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Immediate tax savings. This is because a Dependent Care Flexible Spending Account allows you to set aside pre-tax dollars, immediately reducing your taxable income and thus your tax bill. To sum it all up, we've learned that a DCFSA gives you immediate tax savings because of its pre-tax nature, whereas the Child and Dependent Care Credit allows for tax adjustments according to your actual spending on childcare. The decision largely depends on your income bracket and spending patterns. In order to make the best decision, it's crucial to consult a tax professional or use tax software. By providing them with your financial details and discussing your childcare expenses and income level, you can receive personalized recommendations. This will help you make an informed decision on whether you should opt for the Dependent Care Flexible Spending Account or the Child and Dependent Care Credit. Thank you so much for watching our video on understanding the differences between Dependent Care FSA and Child and Dependent Care Credit. We hope this has helped clarify your options. Please consider liking, sharing, and subscribing to our channel for more insightful content. Share your thoughts in the comments below.